Hello, everybody. Mike Sears here from Sears Wealth Management and Insurance Solutions. We apologize we're a little late. We started exactly on time, and we had a technical glitch, and we had to reconnect. So we hope you're with us. By the way, we don't know who's online with us, and so if you have a question, please feel free to ask it, and then we'll know you're there. But we'd like to welcome each of you. I have with me today Seth Morris, who's one of our advisors and my co-host today. And Seth, welcome. Glad to have you with us.
I'm glad to be here. I think we're going to have to call it a 27-minute Thursday today. Yeah, because of our technical difficulties, huh?
Yeah, we're a little late. One thing is for sure, Seth, is that if anything can go wrong, it probably will, right, when it comes to technology?
At least with us and computers, yeah.
Well, that's for sure. Yeah, that's for sure. So anyway, we're delighted to have all of you with us today, and most importantly, you know, the 4th of July is coming around this Sunday, and we wish each of you a very happy 4th of July with your family and your loved ones, and hope you get a day off with it as well. So have a great holiday. So Seth, what are we going to talk about today?
So today we're going to talk about what role an annuity can play in your retirement planning.
Okay, that's really an amazing, that is really an amazing topic. And I think when we're talking about planning for our retirement, what we're really talking about is, I think the #1 question, Seth, that most people are asking is you know, do I have enough income? You know, can I survive? Can I make things work? And of course, what we're really looking for in an annuity, when we talk about annuities are, they do one thing really, really well, and that is they're great income tools. They're not great accumulation tools necessarily, but they are great income tools. So I think those are some of the things that we want to talk about today.
Yeah, you know, I mean, I think for a lot of people, annuities can be a dirty word. I was talking to someone the other day, and annuities came up in our conversation, and he proceeded to say, you know, why in the world would I ever want an annuity? And I think it's because a lot of people don't understand how they work, because they can be pretty complex. So I think, you know, a good place for us to start, Mike, would be if you can explain just what annuities are and how they work in their most, you know, basic sense.
Okay. Maybe I can step back and make a comparison, Seth. That would be helpful. And why don't we, because annuities and life insurance are both issued by insurance carriers. And as a result of that, let's start with a life insurance contract for about a minute, and we'll compare that to an annuity contract, also with an insurance carrier. That makes sense? Mm-hmm. So Seth, when we talk about life insurance, we actually are talking about creating a lump sum amount of cash that doesn't currently exist, right? Yeah. And we pay a small premium to do it. So let's just say, for example, someone says, our family needs $100,000 and we don't have enough. We don't have $100,000. And so in the event that something should happen to me or happen to the person that owns the insurance, that is the insured on the insurance policy, that we can create money that didn't exist, and we can create $100,000 or $1 million or whatever the need is instantly. And of course, that is the element of insurance that we get through an insurance company. Small premium, create a large lump sum amount of cash from a life insurance contract, correct?
Yeah. So how do annuities compare to that?
Okay. So if a life insurance contract creates money that doesn't exist, an annuity contract says, I already have the money. I've already saved the money. I don't need a life insurance contract to create the money. I've already saved it. I have it. Now what I want to do is I want to take that money that I've saved, transfer it to the insurance carrier, and ask them to guarantee payments to me for a lifetime. Income that I could never outlive. That's what I want. And the insurance element of an annuity is to create lifetime payments that you can never outlive. It can be a payment for my life. It can be a payment for me and my spouse. If I should pass away, my spouse can continue to get the income. Okay, that's what we're talking about. Lifetime income. And that's what an annuity does, is a tool, by the way. That's what an annuity does better than anything That's really its hallmark, really, right there.
So it creates this lifetime income. What would you say to someone who says, you know, I have the money, and I think I can distribute this over my lifetime just fine without an annuity?
And the answer is they may. This is really for the person who says, you know, as we create, Seth, a financial plan for our clients, there's what we're looking is multiple income streams. You know, what are all the income streams that could come to a person at retirement? It could be rents, it could be Social Security, it could be just like you said, right? I have an investment and I just take systematic withdrawals from that investment. I ride the market up and down, right? An annuity could be a piece of that, where that income, a part of that income, is guaranteed over that person's lifetime. And the real question really is not whether or not that is good or bad, but the question is, would it be important to me in my retirement years to have one part or some part of our income that is so reliable it's guaranteed for the rest of my life? And that's what an annuity would do.
Yeah, no, definitely. And so this annuity that you've been talking about, I give the insurance carrier my money and they give me income for a lifetime. That's an immediate annuity, correct?
No, that's right. An immediate annuity by definition says you give the insurance company a block of money, and within 12 months of giving them that block of money, they're going to give you income. And by the way, the income could be not necessarily lifetime. It could be for a period of years. You might say, I want a guaranteed stream of income for 5 years or 7 years or 10 years, and then it's over, right? Or a lifetime income for as long as we both live, and then it's over.
Okay, so this isn't the only type of annuity, though, right? I mean, what other types of annuities are out there? Well,
this is where it gets kind of fun, right? Because there's a lot. Take some notes, folks, as you're watching this one today. So we have an immediate annuity that we've just been speaking about, where we have lifetime income that's coming to you. And I suppose, too, Seth, even before we get to the others, we should probably talk about, because every tool that we use has positives and it has negatives. It has drawbacks, right?
Yeah, so, what would be, what would be some of the drawbacks of an annuity? Because it sounds pretty good. You know, I get this guaranteed lifetime income.
Okay, so let me just draw this on the board real quick. So let's just take this example. You have this $100,000, right? That you have, and you decide that you want to have a guaranteed income stream coming from it. And let's just say that the insurance company says, we'll guarantee you and your spouse, if you're married, an income stream. Again, I don't know exactly what the payout amounts will be. $5,000 a year, $400 and some odd dollars per month. And we'll guarantee that for your life and your spouse's life. So, Seth, what did we have to give up to make that happen?
$100,000?
Yeah, so what we had to give up is that when I gave the insurance company that $100,000, I no longer, it's not liquid to me any longer, correct?
No, I don't think so.
No, it's not. It's not liquid to me. So the insurance company has the money, and I get an income stream for life. I've asked, by the way, Seth, I've asked many of our clients this question. I said, do you like this income that you're getting that's guaranteed? And many people have said to me, yeah, I like that. And I say, well, how do you like this? And they say, I don't like that so much, right? So there's this trade-off. There's a trade-off between guaranteed income and liquidity. Now, thankfully, and we're going to get into this in this program, I can already see we're running out of time, but thankfully there are other contracts that allow us to have access to that money and still get the guarantee. I mean, imagine if you could still have access to this money. And of course, there's no free lunch here, folks. You can't get access to 100% of it if you're going to get the guarantee, but the insurance company have created products that allow us to have access to maybe 7 to 10% of this money and still create a lifetime income guarantee. In the first scenario, when the income stops, everything stops. There's no money left to a beneficiary or anything like that, Seth.
So I could have given my money to the insurance carrier, gotten a few months of payments passed away, and that's it.
And that's it. In a life-only scenario, life only, which is the most restrictive and the highest payment that you could get, right? That's very restrictive. And that would happen for the person who says, I have no other money. I can't even control my money. And this gives me an opportunity to know at least I'm going to get I'm never going to be in the poorhouse. I'm always going to have a paycheck. Mm-hmm. But it doesn't happen very often, and it often is not a good fit. It's a better fit if it's a joint and survivor annuity because it's two lives, mm-hmm. right? So that's not necessarily as restrictive. But what we gave up is access to the principal to get the payment.
Yeah. So what other policies or contracts are available that allow us to have access to that principal and the payments?
So we're kind of moving now into this segment called deferred annuity contracts. And so let me go ahead and just erase this for 1 second, and then I'm going to add maybe a shift to this for a second. So when we're talking about deferred annuity contracts, we're talking about, let's just take the same example. I have $100,000. And when we're talking about a deferred annuity contract, we're talking about not having to take payments, because in a deferred annuity contract, you're not forced to take that lifetime income if you don't want to. I could just simply take a withdrawal, right, out of this contract. And so the real question is how is interest credited on this type of contract, a deferred annuity contract? And we come up with really 3 different types of contracts. There's a fixed annuity, there's a variable annuity, and there is an indexed annuity. You say, wow, then it's already 10 to 5. I don't know how we're going to get all that in. But let me just say briefly that these are long-range contracts, a deferred annuity contract, and that means, let's just suppose as an example, this earned 3% interest. So in a year's time, we earned $3,000 of interest on that contract, but it's tax deferred. If I haven't taken a withdrawal out of that contract, I pay no tax. Tax deferral. It's like an umbrella over the top of this contract. But Seth, if I take income out, then what happens?
Well, it'd be reduced, right?
Yeah. So if I took $3,000 out in a withdrawal out of this contract, now I'm getting to the interest. Interest, by the way, always comes out first, and that $3,000 is now taxable. But what if I take $3,100? I'm in my first year, I earn $3,000 of interest, and instead of taking $3,000, I take $3,100. $3,000 is interest, it's taxable. The $100 is a return of my principal, non-taxable, right?
Mm-hmm. So once I get into my principal, obviously I've paid tax on that, and I'm never going to be taxed on that again.
That's right. I'm never going to be taxed on my original principal if this is a non-qualified contract, meaning it's not an IRA contract. And by the way, an IRA can be owned by an annuity. And of course, the same rules apply for all IRAs. It's all taxable to you. If this was an IRA contract, then no matter what I took out of this, that whole $100,000 that I take out of there is taxable money. But when we talk about it being a long-range contract, one of the things that you want to keep in mind is in a deferred annuity is that the earliest you can get to that money without any penalty, just like an IRA, is 59.5. So Seth, so the penalties for IRAs for early withdrawal is what?
10%.
Yeah, it's 10%. So we would have a 10% penalty if we were to take withdrawals out of that contract earlier than 59.5. By the way, there are some exceptions, but I don't have time to go into that today. There are some exceptions to this. But in a deferred annuity contract, remember when we talked about immediate annuities, all annuities have the ability to take income out of this on a lifetime income basis or on a guaranteed basis. But I don't have to take money out like that. I could take money out just like a systematic withdrawal like everyone else does in a bank. So let's change this for a second and let's call this a fixed income annuity, because the difference between fixed and variable and index has a lot to do with how the interest is credited in those accounts. So Seth, what do you want to ask me on this one?
So, I mean, fixed annuities, from my understanding, those look a lot like CDs, don't they?
Yeah, they do.
Yeah. How do those ones work?
Okay, so you know that if you went to the bank and you asked for a 1-year CD or a 3-year CD, what would they offer you? They would offer you an interest rate, and they would guarantee that interest rate over that period of time. The insurance company will do the same thing. If you got a fixed annuity, they would guarantee the rate. And it's usually, most of the contracts are 3 years, 5 years, 7 years, and 10 years. Obviously, the longer you go, hopefully the more interest you will earn. However, I must say to you that the longer contracts today, because of the uncertainty and the interest, aren't necessarily more. So the fixed income annuity is a guarantee of interest over a period of time. And of course, Seth, should we talk about surrender charges?
Yeah, I was just going to ask you. So let's say I have a fixed annuity. I'm 59 and a half, and I have a 10-year fixed annuity. Does that mean I can't get any of my money for 10 years?
No, it means that you can only get the contract. Most of the contracts will allow you to withdraw either interest only, 7% of the contract value each year, or 10% of the contract value each year without penalty. And it's usually a declining surrender charge. I'm going to use a 7-year contract just for time purposes. And so if this were a 7-year contract, we would have 7 years, 6, 5, 4, 3, 2, 1, 0. So in the first year, the surrender charge schedule might be, and again, I'm making this up because every contract is a little bit different, right? The first year, the surrender charge might be 7%. If, and only if you take out more than the free amount, which would be interest only or 10% of the account balance, whatever that amount is free that they'll let you take out. The next year would be 6, 5, and of course it would be reduced. And at the end of that 7-year period of time, there's no recurring surrender charge for most of the contracts. Some of them have a renewal feature at the end of 30 days. You go right back into this. But most contracts have a surrender charge schedule. Why? Because this is a long-term investment.
Okay, so let's say that their free withdrawal amount is 10%. I have $100,000. If I take $10,000, I'm okay. But if I take $10,001, then I'm into the surrender charge? That's
correct.
Okay.
Yep, that's exactly right. So the only time so the question would be, well, why would you buy one if it has some liquidity issues here? And the answer is because people want guarantees. People want safety of principal. That is probably the most important reason. When you hear the word annuity, you should hear also the word safety of principal or guarantee of income as a tool. This is where this fits more than any other. So let's move off this one for a minute, Seth, and let's go to, we just have a few more minutes. Let's go to a variable contract. A variable annuity contract credits interest just like any mutual fund that you could buy on the street, except it has all the features of tax deferral that we've been talking about. You can't get to money until you're 59 and a half. It has lifetime income features that are part of that contract. But on that type of a contract, a variable annuity contract, you have all the upside potential that you can get, but you also will participate in all start market losses as well. So there's no buffer on the bottom side. There's no cap on the top side. And actually, if we had more time, we could go into this a little bit more detail. They're actually quite expensive from a charge point of view. But that's what variable is. So on one side, a fixed has a guarantee, looks like a CD. A variable looks more like a mutual fund with tax deferral and guaranteed income available to it, which I guess that leaves us with the last item.
Yeah, so indexed annuities.
So an index annuity is kind of like a hybrid. And let's see if I can do this in just a few minutes. So if we had an indexed annuity, links interest to some external index, like the S&P 500 or the Dow or something along those lines. Okay, that's what we're doing there. And so I'm going to draw a line here that is not representative of the stock market, but I'm just for effect. Let's just say, for example, that this is the S&P 500. It has some volatility to it, and it's increasing over time. If we were in the actual stock market, we would ride all the ups and we would ride all the downs, if there are any, right? And usually there's some volatility that's coming. So an index annuity, because we never put any actual money of the client's money in the actual index, we simply just buy an option on that index. And if the interest is positive, usually the crediting method is we get interest up to some cap, or we get a participation in some portion of the index, or some part of the index will decrement a part of the gain. So if we look at the index annuity, we can only make money when the index is positive, and when the index is negative, it's a zero, because we have no losses. Why? Because we have no money in that index. So it might look something like this. I don't get all the gain, and when the market is down, it's flat, it's a zero. I don't participate in the negatives, but I also don't get all the ups. Again, this is a very simplified drawing, but you get the idea that I'm only participating in a portion of the gains, but none of the losses. Of course, if the index is negative every year, this is just a flat line. It's still no losses, right? And so the index annuity is a nice hybrid, because I call it a hybrid because of the opportunity to get returns potentially in excess of a fixed income product that has a guarantee, and it doesn't have the volatility of a variable annuity where I get all the upside. So if you're looking just for all the upside, it may be that the index product is not the right way to go. It may be that there's even other investments to look at. But if someone says, I'm looking for, I want to participate in some of the gains in the index, and I don't want to participate in the losses, and I have an income need that I want to be guaranteed, because these products have tied to them an income rider that if I can build 5 to 7 years into that contract before I take income, I can not only have access to a part of my principal, but I can also, just like the immediate annuity, without giving up access to my money, I can have a guarantee of income for the rest of my life, or if I'm married, to my spouse's life. That's an index annuity. Yeah.
So with an indexed annuity, what happens when, I've started taking income from it, or, my wife's taking income from it, and we pass away? Then does the insurance carrier get the rest of our money?
No, they don't, actually. In an index annuity, in a variable annuity contract, whatever is remaining in the actual contract itself will go to the beneficiary that we have pinpointed in our contract. So we haven't locked ourselves out of the money. But I would say to you, if you're taking guaranteed lifetime income out of an indexed annuity, usually sometime in your 80s, you spent most of the money that's in the contract. So even if the contract value goes to zero, the income stream will continue for a lifetime, as long as you live within that income stream that they guarantee to you. If they said the income guarantee is $25,000 a year, as long as you don't take out more than $25,000 a year, that income is guaranteed for life.
So would someone want to put all their money in an indexed annuity? I mean, it sounds pretty great.
Yeah, no. Seth, when we design financial plans, each one is an individual, each investment is an individual tool, correct? And each investment is designed to do specific things. Every financial plan has a need for income. It could be that every financial plan has a need for some part of that income that is guaranteed and reliable. Some part of that financial plan is needed for total liquidity. I need to have access to all of those funds. Some part of that financial plan, the investments may be for growth purposes only. And those are assets that I'm not going to take for income purposes. And so an index annuity fits, or these annuities fit the bill for someone who says, I want a portion of my total investments where I have safety of principal, and I have a need for some part of it to be lifetime income, which is almost never all of it. In fact, we would never do that because there's other needs besides just the income. But I must say, in a financial plan, what we're looking to do is to solve income first. And an annuity may be part of the way to solve that income need.
So these are tools, and if it's the right tool for the right job, then great. And if it's not, you wouldn't use it.
That's correct.
Okay.
And there's some people that would not use it at all. It doesn't fit in the way that they look at their future and the way that they feel about risk. And so then there's situations where that annuity doesn't fit at all. And yeah.
Okay. Well, I think we're kind of closing in on our time here. I know we started late, but I think we're coming to an end.
All right. Well, I think part of the excitement for these things, I don't know, I hope this is positive for all of you who are attending. And we love doing it. And it causes no small stir among us because we're trying to give you the very best that we can. But I'd like to announce the raffle winner, and the raffle winner is Craig Covell. And so Craig, our team will be reaching out to you today, and you'll be getting a gift card to, I'm sorry, you're not getting the dinner, you're getting the C's candy, sorry. If you want the dinner, call us, maybe we'll change it. But Craig Covell, Craig, you've just won, and we're excited for you. Our next Facebook Live will be on July 15th at 4:30 p.m., and we're going to talk about understanding market corrections. That should be a very exciting topic, and I hope all of you will tune in. So signing off from Rancho Cucamonga, Seth and I bid you farewell until we meet again. Have a wonderful day. Take care.
All right. Thanks.